My name is Houston, and I am a business analyst. I have a master's in business administration with focuses in accounting and business analytics. My job is primarily to analyze business changes in my industry, logistics, and determine what the resulting regulatory and compliance requirements will be, as well as projecting what that may do to company management, the business as a whole, and operations. With this experience, I'm going to take a look at all the companies reporting earnings this week and talk about what I think are the 5 most worthwhile to watch. Keep in mind that all the statements made are based off of market and business analysis and should not be taken as financial advice. At number 5, we're looking at UPS. As I mentioned in yesterday's video, UPS recently completed layoffs of over 12,000 personnel. The earnings report this morning will likely reflect savings on those layoffs as most severance packages were paid out prior to quarter 2. This means that profits should benefit from significantly reduced labor costs. However, UPS's recently renegotiated wages with the Teamsters Union could potentially outweigh the layoff savings. Additionally, one of UPS's largest customers, Amazon, is expanding their last mile logistics to offer proprietary delivery to an ever-growing list of customers. UPS is facing strong macro and microeconomic headwinds that will be difficult to offset in the short run. The next few quarters of earnings will determine whether it continues its gradual decline or pivots towards a more promising future. Already now at 8:45 in the morning, UPS barely missed earnings per share, and it caused a tumble of almost 12% in the course of 2 hours. We'll see how that levels out over the next couple of days. At number 4, we're looking at 3M. The sweetheart of dividend and value investors, 3M is reporting their quarter 2 earnings Friday morning pre-market. The embattled producer of adhesives, personal safety equipment, and advanced materials is still negotiating their multi-billion-dollar settlement over their use of forever chemicals. Adding to these headwinds, 3M recently cut their quarterly dividend from $1.51 a share to just 70 cents. These downsides have resulted in remarkably low investor confidence, and the firm is not still fully recovered from hitting their 10-year low earlier this year in February. However, all the factors just mentioned are priced in, meaning this earnings report could mark a continuation of 3M's 3-month bull run from the bottom. While it is unlikely 3M will experience a substantial shift in either direction, implied volatility on options is quite high right now and anything is possible. At number 3, we're looking at Google, which is reporting their earnings today, Tuesday, after market close. Google has recently entered a period of high volatility. They've had a long-term plan to eliminate the collection of third-party cookies through their Google Chrome browser. The intention was two-part. It would improve security features of the browser, and it would restrict user data collection to Google and companies paying Google for data collecting privileges. Late yesterday afternoon, Google abandoned this plan after significant pushback from advertisers. This initiative was one in a list of many experimental CapEx projects Google has been focusing on to maintain their market dominance. The most significant of these projects, Google AI, is experiencing growing pains as users find numerous errors in the AI search function. Google is spending a significant amount of time and resources on innovation and high-risk, high-reward projects. So long as they continue to improve their core competency, data collection and data aggregation, Google's long-term outlook remains stable to positive. At number 2, we're looking at Chipotle, which is reporting earnings Wednesday after close. Chipotle's business structure is solid, as they maintain an 11% market share in the fast casual restaurant segment. Chipotle has a strong brand identity as well, and its management acts on this brand identity. The largest negative factors for Chipotle are all macro-environmental. Their business model relies on the availability of fresh produce, which is inherently volatile. This volatility makes Chipotle's growth and expansion a bit of a catch-22. More stores and more sales mean a greater demand for produce. This increased demand places a greater strain on fresh produce supply lines and exacerbates shortage risks, forcing restaurants like Chipotle to rely on pricier and lower quality overseas imports. Another significant macroeconomic threat for Chipotle is domestic consumers decreasing discretionary spending on restaurants and takeout, which, when measured by net intent, is down 4 points quarter over quarter for 2024. Chipotle has a strong business model with loyal customers and confident investors. Their success hinges almost entirely on how well they negotiate growing external pressures, and because of this, the relatively stable firm faces an unpleasant amount of volatility. Finally, my number 1 pick for top stocks to watch this earnings week, reporting earnings Tuesday after market close, electric vehicle manufacturer and industry maverick, Tesla. Currently at the top of a 3-month bull run, Tesla retains a remarkably high price-to-earnings ratio of 61. While this isn't necessarily a negative indicator, it does indicate potential overvaluation. Recently, Tesla has shifted focus from growth and innovation to development and refinement. They're focused on making their current offerings more affordable and better optimizing the production process. By decreasing costs and expanding their consumer segment, Tesla plans to maintain their strong margins while hopefully increasing their order volume. Tesla is the largest automaker by market capitalization, with their valuation of $811 billion making up a third of the entire segment's total capitalization. Their order volumes, however, are still well below even much smaller competitors like Renault. Indicators like this show that Tesla has its priorities straight when it's focusing on order volume. And this focus may already be showing results, as second quarter sales figures might place Tesla's Cybertruck as the best-selling electric truck for the year, beating out the Ford F-150 Lightning, meaning Tesla still has the edge when it comes to consumer sentiment. Those are my picks for the top 5 stocks to watch for during this earnings week. If you like this content, consider subscribing. I posted a video just like it yesterday, and I'll be posting a video just like it tomorrow. Let me know in the comments what you think.